now, and because it'll just take a minute or so until we get to the bits where we're talking actually about VAT. So my usual slide and bit about me, and the usual disclaimer and reminder that you'll get a recording of this. Just double check we are recording. Notice it warned me we were, so it's recording. Just checked in the top left-hand corner, so I'll go back to that. And just a reminder that it's part of all the series of webinars I've done, mainly on accounts and tax issues, but also some stuff on that we've still got to come on pensions, property filter. We've got one coming on that. Mortgages I've done, but that's being repeated. So in a few weeks, still looking to find a solicitor who won't charge me thousands of pounds just to allow them to promote themselves on here. But that's lawyers and solicitors for you. Only people I can't seem to get hold of. So I'll talk about basic VAT in general, and then Jack will talk about more advanced aspects, particularly those related to property. We'll have a Q&A and close by 9:30 at the latest. Usually goes pretty close to that, but we'll see. I do tend to provide quite extensive notes and perhaps cover one or two areas that I won't probably dwell on. Sorry, I just clicked out to let somebody in. That I won't dwell on too long, but at least you're aware that the notes are there. So let me just check how I re-find my slides, because I seem to have jumped right out of it. I may have to screen share again. Let me just check. Yep, I do. So I'll watch out for that while people are coming in. So we'll probably make a start now. I've completely jumped out of it. That's silly. That's it. That's where I was. Okay, so that's an index. I won't read through that. You can just use it if you want to use the slides. So basically, VAT is designed to have no effect on two businesses where both are VAT registered, because one will charge the other one and the other one will reclaim it. It will affect businesses where only one is VAT registered and the other one isn't. Obviously, the one that isn't VAT registered will be charged VAT and won't be able to claim it. But it's also a slight disadvantage in those circumstances, even to the business that is VAT registered, because they may be less competitive when doing business with others. VAT is basically, though, designed to affect the end user. Poor old you and me, as usual. So that's an example, really, of how VAT does or does not affect, doesn't affect two businesses that are both VAT registered. I won't go through it in detail, but it shows you the effect of a sale, charging £10,000, £2,000 plus 10,000 plus 2,000 VAT. Well, yeah, you have to pay the full 12,000, but you'll claim the £2,000 back. And that's just the opposite when it comes to buying things rather than selling things. So again, two VAT registered businesses, it doesn't affect them. I think this is where we start getting to the things that we really need to start understanding. There's five types of VAT supplies. Standard rated supplies, which can be at the standard rate of 20% or at the zero rate of 0%. I didn't put 0% there, but obviously that's 0% for zero rated. And reduced rate supplies of 5%. And there are two other types of VAT supplies, exempt supplies and outside the scope, which we'll come to. Obviously, we'll go through them all. For those who've just come into the webinar, if you've got your audio ready now, we've really just started, to be honest. And there's five types of supplies: standard rate at three different rates, 20, 0 or 5, and exempt or outside the scope. Excuse me, let's just click off that and turn the slide. Okay, so just to reiterate, standard rate supplies at 20%, which is basically just about everything. Everything else are really exceptions to it. Zero rated supplies, 0%, and reduced rate, 5%. Examples of some zero-rated supplies. Example of some zero-rated supplies, mainly cold food, sandwiches. Jack might just correct me here. Obviously, hot food, even in takeaways and meals in restaurants. I think cold food, Jack, like a cold sandwich, I think that's zero-rated, isn't it?
So it depends if it's to eat in or to take away.
That's right. Yeah.
With food, it's quite complex.
Very complex.
You'll be glad to know.
Yeah, it is complex, but we're not here to dwell. But I just I just thought I'd get Jack to check that for me because I know it's complex. Other few things like books and newspapers, children, clothes and shoes, and public transport. Examples of reduced rate supplies, just a few things like that. Although Jack will talk about materials and things when it comes to builders, which is probably the main one that we're interested in, the reduced rates, 5%. Exempt supplies are supplies that would be zero rated, but for technical reasons they can't be. For example, insurance is zero rated, and postage stamps. It's basically where it's the provision of a service to supply goods. So the post office is supplying stamps, and an insurance broker is supplying insurance. May not. Anyway, yeah, it is complicated, those sort of things, and Jack might pick up on that later. But it's really just to be aware of these things.
Do you mind if I just
jump in there, Jack?
Jump
please.
in
Yeah.
just on a common misconception that we often get. So as Clive said, there's three types of taxable supplies: standard rated, zero rated, reduced rated, and then you've also got exempt supplies. A common misconception we come across is that exempt supplies and zero rated supplies, because there's not a positive rate of VAT due on either, people assume they're the same thing. Just to outline the distinction between the two. So a VAT registered business can recover input tax where it relates to an onward taxable supply. A zero rated supply, such as books, children's clothing, is a taxable supply. So you can recover input tax in relation to that. But exempt supplies are not taxable supplies. So you can't recover input tax incurred on purchases in the provision of exempt supplies. I just thought that was you might touch on that in a minute, Clive, I don't know, but I just thought that was a distinction worth highlighting because it's something that we often see gotten wrong.
It's a common misconception, and to be honest, it was a good explanation because I've always found it, although I understand it, it's quite wordy to actually work out how to explain it. So that's a good way of doing it. Some more examples of exempt supplies: healthcare, insurance, education, fundraising, memberships. If certain conditions are met, memberships, that is, again with fundraising, doctors and dentists. Outside the scope are where no service is provided. For example, rates are outside the scope because the council that send out the bills are not providing a service, as they're merely posting the bills on behalf of the council. Is that a good explanation of outside the scope, Jack, would you say?
Yeah, so there's two types of outside the scope supplies. I think that what you're touching on there is where it's not consideration for a supply. So money given in exchange for something. So if you give a tip at a restaurant, you're not giving that money in exchange for a service. So that's outside the scope of that. But a second instance in where you get supplies that are outside the scope is in the context of services provided abroad. I don't know if that's something you want to go into or not.
Probably not, unless it comes or we have time, but probably not. To be honest, most times you don't need to know outside. You just need to know which things are outside the scope from a list of them, really. For most businesses, especially in this country. I did talk briefly about difference between exempt and zero, but I think your explanation was better. And it's so I'll move on from that. So the types of registration and deregistration. Compulsory registration is where in a rolling 12-month period your taxable supplies, commonly known as turnover, sales or income, has gone over the registration threshold, which is now 90,000, or where when you expect your taxable supplies in the next generation, in the next 30 days, I don't know where generation came, in the next 30 days alone will go over the registration threshold. I've just done that just to show you that it is a rolling 12 months. So if today we're in May 24, the second column there, then you do have to look at the 12 months turnover, taxable supplies, from June last year to May this year. It's not your accounting period or a calendar year. It's a 12-month rolling period, and you need to keep, if you think you're close, you need to keep that those figures. Voluntary registration, there's absolutely nothing to stop a person registering, however little their turnover is, and they can register, and nobody would, and HMRC will register them. And reasons why you might want to do that is to take advantage of one of the schemes, like probably the flat rate scheme. You want to claim VAT on your costs and expenses because you think that's going to be worth more to you than losing customers by having to charge them VAT. It makes you look bigger than you really are, so it could be just a profile thing. Some big businesses won't actually even deal with you if you're not VAT registered. Not really sure why, but they just use it as a tick box to see that you are, higher profile. As I said before, it may not affect your business if your customers are all VAT registered themselves and can reclaim the VAT. So at least you win by being able to reclaim your VAT. Change the slide. Deregistrations. If your VAT taxable turnover for the previous rolling 12 months is less than or equal to 88,000, or if you expect it to fall to 88,000 or less, just correct me there, Jack, if the expectation in the next 30 days, like registration?
Yeah, I mean, if your taxable turnover is going to fall that significantly,
yeah,
then yes, you can say, for example, if you've entered into quite a large contract that makes up the majority of your turnover, that's pushed you up above the threshold, that contract's ending, you can apply to deregister on the basis that you know you're going to be trading below the deregistration threshold going forward. Although HMRC will likely ask for evidence of that, or a rationale behind it. I don't know if Justine's got a hand up to ask a question.
Yeah, unmute if you have, Justine.
Oh, sorry. Yeah, no, it's Andrew actually, glad we're both
okay.
Yeah.
I just noticed in the previous slide there, you were talking about reasons why you might register. But if you are under the threshold and you've registered, you're saying that people are allowed to claim on the VAT on things they're buying at that stage. Is that right?
Yeah, I mean, that's the main reason someone would voluntarily register, because it allows you to recover VAT you're incurring on your costs in making those taxable supplies. I mean, in my mind, that is the main reason someone would want to do that. Now, it's especially relevant if your customers are VAT registered businesses, because the value of your service doesn't go up because they can recover the VAT element. However, if your customers are consumers, non-business persons, if you register voluntarily, your prices essentially go up by 20%. So it's really balancing out the effect on you in recovering the input VAT, as long as it relates to the provision of taxable supplies, and the effect it'll have on your customer, whether it essentially increases your prices or not.
I think you've kind of answered another question I was going to ask, because I was going to ask Clive in one of the previous slides a bit further up about registering, because if we haven't reached the VAT threshold limit and we decide to register before we get to there, are we having to be expected to start charging VAT at that point where we haven't reached the threshold?
Yes. If you register for VAT, you've got to charge VAT from your effective day of registration on all taxable supplies made. But again, that's borne by your customer. So if they're VAT registered, really, and you're incurring a lot of input tax, it might be something you want to look at. If you're not incurring a lot of input tax and your customers are non-business persons or not VAT registered, you'd probably not bother unless you are required to by exceeding the threshold.
Okay. Well, you've answered a couple of good questions for me. Thank you very much for that.
Yeah, no problem. Thank you. Okay, so we've just done deregistrations. Exception from registration, possibly an overlap with what Jack said before about if you had a one-off contract. But if you do appear to have to register, but you know that it was for exceptional circumstances, then you can, in writing, ask HMRC to actually allow you to not register. So that's something to just bear in mind if ever you have a blip in work, a good blip that takes you over the limit. but you'll be immediately under the limit thereafter. Disaggregation, something that I think there'll probably be questions on tonight, and it is a difficult area, but it's really where people try to start separate businesses in order to avoid registering. And I think the sort of question we get with property is, if you've got a HL with an £80,000 two HLs each with £80,000 turnover, then you obviously might prefer to not have to register that business if they're separated in some way, because separating them avoids the turnover being 160,000 between them. So I expect some questions later on that. So unless Jack wants to come in, perhaps while we're doing that now.
Yeah, so disaggregation is, in HMRC's view, the artificial separation of businesses to avoid having to register for and account for VAT. So in determining whether businesses are artificially separated, they'll look at a number of links. They'll look at organisational links. Do the two businesses share the same staff, equipment, directors, premises, things like that? They'll look at whether the two businesses are financially independent of one another. Are they seeking to reach the same economic objective? Are they providing goods or services to the same pool of customers? So it is a tricky one, disaggregation, because what HMRC do is they provide a list of factors and then essentially say, decide for yourself. But as with VAT in general, if you've got it wrong, they will assess you for it. They're not willing to give advice, but they're willing to assess someone if they get it wrong. As a self-assessed tax, that is the danger with that. But really, you've got to consider those links. How closely connected are the two businesses? And if you keep them separate, and HMRC come in and say, well, this is one business, you may be required to backdate a registration to when the two businesses first exceed the threshold and retrospectively account for VAT, which can provide its own issues, particularly if customers aren't VAT registered, they're not going to pay it. So it is something to consider. I've had clients who provide two completely different businesses. That one's a garden business, one is a dance tuition. Now, subject to not using the same premises, equipment, it's clear that they are two completely different businesses that aren't reliant on one another. But if you've got two businesses operating in the same sector, it's a harder argument to make.
Yes, absolutely. I mean, the classic, because everyone understands it, it all started with the pub, didn't it? Where the catering was done by Mr. or Mrs. landlady or landlord, and somebody else ran, and the partner ran the pub. So we can't really give definitive advice. I think you have to look at that basket full of circumstances. To what extent does it? I mean, can it help to separate the business into separate limited companies, partnerships, etc.? Jack, any comments on that?
Yeah, well, I mean, splitting it up into different limited companies. I mean, if those limited companies have separate bank accounts, separate staff, separate premises, and the separation is more complete. But again, HMRC will also look at what sector are they operating in, what sort of goods or services are they providing. And if the two go hand in hand almost, like the example with the catering in the pub, it's pretty inarguable. They're providing the same pool of customers. One benefits the other directly. I think that's, for me, that's the more prominent thing to look at.
Yeah, I wanted to eke out that comment from you really by introducing the aspects of the limited company. I think people who are running two or more HLs, but they're using different ownerships, I think they have to seriously consider whether they're taking a chance there. And, without saying they're right or wrong, I think that you need to look closely at what you're doing if you want to, be sure to avoid a problem. But I'll leave that till later or another time. Made the point. Chopping and changing. So in and out of that, you can't register, deregister. Obviously, you can register when you have to, and you can deregister when you can. but you can't chop and change. There are rules about this and provisions to avoid this chopping and changing. So if you register and join the scheme, like the flat rate scheme, you can't do it for 6 months and then decide that it's not good for you and then back in later on. So you can't chop and change. So just bear in those provisions in mind if you're thinking of doing that. So quick run through the VAT return. Most people know it's got 9 boxes. Outputs is the output on the VAT on your sales, your turnover, rent if it applies, and it can do. And so box 2, we'll come to box 2, but won't dwell on it because that's to do with import and export. So box 3 is simply 1 and 2 added together, and that's your total outputs, the total VAT you owe to the VAT man. Box 4 is the total VAT that you can claim, input VAT on your expenses. So box 5 is 3 less 4, which is simply how much do I have to pay, or you have to pay to the VAT man for this period, usually a quarter, but can be a month or can be monthly or even annually. I'll show you that later. Or even how much you'll be refunded if your input reclaims are higher than your outputs. Box 6 is very simply the net amount of the VAT on your sales, your income, whatever you prefer to call it. And box 7 is the net inputs, which is the net amount. So just to give you an example of what net VAT and gross are, £100 net plus £20 VAT is £120 gross. So when I talk about net outputs in the previous slide and net inputs, I'm talking about the net amount, £100 in that case. People get a little, I'm not being flippant, people get a bit excited about box 6 and 7. They don't change how much you owe to the VAT man or how much you claim back from him or her. I think they're there for statistical reasons more than anything. Box 8 and 9 will come to when we talk very, very briefly about imports and exports, which is actually now. I might ask Jack to jump in here. I know he says it's a very big topic, which it is. But Jack, would you just do me the service of 2-minute summary of that, please?
Yeah, sure. So I think in terms of buying goods and services outside the UK and purchasing them from outside the UK, you need to break it down really into 2. So that's goods and then services. In terms of goods, if you ship goods outside the UK, then that is a 0-rated export. So you don't charge UK VAT. Now, you need to evidence the fact that the goods have left the country to allow you to 0-rate it. That's by retaining a copy of the export declaration showing you as the exporter. If you've not got that evidence, HMRC might ask that you charge UK VAT. And obviously, an EU business, for example, isn't going to pay you VAT. So you need to have that evidence. And then conversely, when you import goods into the UK, the country which you buy it from won't charge domestic VAT. Instead, you will incur import VAT at the same rate as if the goods were purchased in the UK, which is recoverable as input tax. You won't have an invoice, so you'll either need a C79 import VAT certificate or a postponed VAT statement. That's the only evidence. A freight forwarder's invoice showing the VAT is not acceptable. And when we talk about services, there are rules called the place of supply rules, which determine where a supply takes place for VAT purposes. For business-to-business supplies, the general rule is VAT is due in the location of the customer, which means it's outside the scope of UK VAT. You don't charge UK VAT on that. And then the business will self-account for VAT in their own country on the VAT return and recover it as input tax. So it's a nil net effect, essentially. There are exceptions to that general rule, like land-related services. VAT's always due where the land's located. You might need to register in that country. If you buy services in from abroad, if it's subject to the general place of supply rule, you will self-account for VAT on your VAT return, which you can recover as input tax. And it likely won't charge domestic VAT unless it's subject to an exception, but that will likely mean they've got to register for VAT in the UK and charge UK VAT. Sorry if I've rushed through that.
Yeah, no, that's great. It is a complicated area, and most of us won't be involved with it, so at least people know about it. I think it was Nick who was asking me about this particular thing a few weeks ago, the reverse charge services from outside the UK. So a lot of us have services like software, Adobe, and things like that that comes from Germany, I think, or somewhere, and that's how it's accounted for. It's in and out, so it has a net effect.
Yeah. So the way that happens is, say it's £1,000 plus VAT, the value of the service. You would account for £200 VAT in box 1 of your return, so you would pay VAT on it, but you would include an equal charge in box 4 as input tax. So it essentially cancels each other out. It only really becomes a major issue if you are exempt or partially exempt, because then you've still got to pay it on your VAT return, but you can't recover all of it, if any of it. So I don't know if Nick, you've got any specific questions on that. You can always follow up with Clive or myself afterwards if you have. But if there's anything you want to ask now, I'm happy to.
Yeah, I do have several specific questions, but I think I'd like to wait and hear what else you have to say, Jack, before I come to them.
Okay, no problem.
Just so you know, I am voluntarily registered for VAT.
Mhm.
I've done it for exactly the reasons you suggested, for credibility and basically to recover huge amounts of VAT on my training cost.
Yeah,
I've given lots and lots of money to gurus.
yeah, absolutely. I did go on to mention that you put it in box 2 and box 4, like Jack said, so I won't dwell on that now. And that's where the box 8 and 9 comes in. So the net value, £1,000 of that, those fees that Jack was referring to, could go in 8 and 9.
Boxes 8 and 9 would only apply where you're trading goods between the EU and Northern Ireland. The net value of reverse charge services would go in boxes 6 and potentially 7. 8 and 9 solely relate to it's post-Brexit Northern Ireland Protocol stuff. Basically, if you don't trade from or into Northern Ireland, you can avoid 8 and 9.
Lovely, thanks for that. And my note did say goods there, but I certainly didn't refer to Northern Ireland post-Brexit, so thank you. Okay, VAT schemes. Let's jump straight in. The flat rate scheme. If you're VAT registered and you want to use the flat rate scheme, then basically you do not, I repeat, do not reclaim any input VAT on any of your expenses. However, you charge your customers the full 20%, but depending on your flat rate scheme rate, and let's pretend it's 10%, so if you've charged £1,000 and your customers paid you £200 VAT, then you only have to pay the VAT man £100 of that. So you save £100, but you don't reclaim any VAT on any expenses. There is one exception I'll come to in a minute. It is only for small businesses, unless I've not updated this. It's £150,000 turnover. So it is only for small businesses, but the percentages that there's some examples of percentages. The ones that interest us, perhaps, as property, estate agency, 12%, real estate, 14%, general businesses, where the depending on the percentage of labour included, either 9.5% or 14.5%. There's an example there, but I won't go into it. But it's a clear example using the £1,000 example I just used, although not the 10% reduced amount. I used 14.5 here. That's a little saving that you can make, and it can be quite reasonable. The lower your flat rate down to 10.5%, that's a great rate. I wish accountants were that, but we're up at something crazy like 16 or 17%. Can't remember now. And that's the sort of savings you can make. You even get a bonus of 1% just in the first year of being on the flat rate scheme. So that's the savings with the bonus. There is one exception to that, and that's where you do spend a significant amount of money on a capital expenditure. And that has certainly, well, considerable amount, £2,000, a really good computer or something like that, or a van. Then you can claim the VAT on that. It's got to be a single transaction exceeding £2,000. So that's just to prevent people losing out when they do spend a significant amount of money on one item as a one-off, because they don't want people dropping in and out of the flat rate scheme. You're not allowed. The special warning here, Jack might come in on this and explain this better than me. But if you are on the flat rate scheme and have any supplies that are exempt or zero rated, Jack, you'll correct me in a moment, then because with the flat rate scheme, it's all or nothing, and you have to pay your percentage of all your income, regardless of whether you've charged your customers any VAT, it can be really significantly damaging. Sorry about the spelling there. Can be seriously damaging to bother the flat rate scheme and to be in supplying zero rated or exempt. Can you just clarify that for me, Jack?
Yeah, so in terms of if your services are going to be zero rated, the flat scheme wouldn't really be appropriate, because you would essentially still be required to charge them 20% VAT, which is obviously an increase than where it should be zero rated. And from a recovery perspective, if you're making exempt supplies, the flat rate scheme, as Clive has said, has VAT recovery built in. You can't recover input tax, but where you charge them on 20%, but you've only got to pay over 12% to HMRC, it's built into that already. So if you're making exempt supplies, it's not appropriate either.
Yeah. It's just a trap. So just be careful if you think of registering for a flat rate scheme to think about that particular issue and take advice. So as I said, flat rate scheme is not for everybody, and you've got to look at your circumstances and work out the advantages and disadvantages, costs and benefits. Very briefly, going to run through this now. You can opt to do monthly or annual VAT returns. If you do annual ones, you do have to pay 9 standing orders and then a balancing payment. So it doesn't stop you having to pay. You'd go on monthly probably if you were in a permanent refund position. Otherwise, you would stay on quarterly. Cash accounting, it's very simple. You account for VAT when you get paid by your customer, and you claim that back when you make payments to suppliers. There are some rules about cash accounting in terms of limits. I think Jack is going to talk about the construction industry and the reverse charge, so I won't. Other schemes, not going to go into them, probably irrelevant to most people, but if you happen to do second-hand car sales, second-hand goods, motor cars, restaurants and things, capital goods, then there are schemes and there are many more available to your particular industry. Other issues, not going to talk about them, but just to make you aware of them. If you claim that back, for instance, on petrol, you may have to pay the fuel scale charge unless you keep sufficient records to avoid doing so. Just watch out for privately used items, things that are specifically not allowed to claim VAT back on, like entertainment and most gifts. I think the only one out of that I will probably mention is the one next to the bottom. And that is if and when you do register for VAT, you may be able to claim VAT back that you've paid on services within the last 6 months and on goods or equipment, etc., that you've still got that you've bought within the last 3 years. So think about that, not necessarily always as a reason to register, but think about it if and when you do register, if there's any VAT that you can claim back that you've incurred on services within the last 6 months and goods and equipment, etc., still on hand in the last 3 years, which is quite generous. And I have used a number of times that. Other issues, record keeping, tax points, deposits, which could be relevant to property, pro forma invoices, discounts. Bad debts is an agent at the bottom. Again, we're not going to go into those. 2 very big areas. But the purpose of these last couple of slides is really just to make you aware that these issues do exist. Certainly not comprehensive, but I think what I've spoken about so far in these 2 slides with the other issues on them are things that are most likely to be of interest to you. I'm going to hand over to Jack now to talk, share his screen, so I'll unshare mine, and he will talk about the issues relating mainly to property. Over to you, Jack.
Okay. Can everyone see that?
I can see that.
Okay.
Yeah, I can see that. Yeah.
Okay. So hello everyone. My name is Jack. I'm from a VAT and customs consulting business called the VAT People. We are a firm based in Stockport, just outside of Manchester, and we specialise in all areas of VAT and customs. So just from the outset, I want to say if you've got any questions at any point after the presentation about land and property or anything else VAT and customs related, I can be contacted at that number and that email address. So I've been asked by Clive just to speak about the impact of VAT around various land and property transactions, which I understand you've all got some form of interest in. It's an area we work in a lot, particularly because the surrounding legislation can be complex, even by HMRC standards, particularly for those that aren't that don't deal with that a lot. Another reason that we do a lot of land and property advice is due to the high value nature of land and property transactions. They're some of the most expensive transactions that you can get, and that's particularly relevant because if you get anything wrong in relation to land and property, if you underpay VAT, you may have HMRC raise an assessment and penalties for VAT owed. And now, as penalties are calculated as a percentage of VAT due to them, consequently, penalties in relation to land and property transactions are higher due to the high value nature of the transactions. As we've not got a lot of time to talk about things, I won't go too in depth into what are quite complicated areas. So if anyone needs to discuss anything specific we don't have time to touch on this evening, feel free to contact me at those details. But also, I'm happy for people to interject if I'm talking about something that's relevant to them and they've got a question. I'm happy if someone wants to raise their hand or just turn me off and ask the question. That's no problem. If we get short of time, I'll rush through things if needs be. So here is a brief summary of topics I'll be covering. So what I'll look at is the VAT liability of various supplies in the land and property sector, the different VAT rates applicable to different things. I noticed Clive had a slide before various schemes, including parcel exemption, capital goods scheme, TOMS. I'll touch on all of those. I'll talk about the option to tax, the DIY house builder scheme, the reverse charge in the construction industry. So as Clive mentioned in his slides, there are various different VAT rates that can apply to suppliers of goods and services. You've got the taxable rates of standard rating 20%, zero rating, reduced rating 5%, and you've also got exempt transactions. And in the next bit of time, I'll look to cover the various supplies that can be defined as one of those four. So whenever you're undertaking a project in land and property, what we advise is that you establish the correct rate as early as possible. That's both in terms of any construction services you purchase in building something or converting something. You want to know that you're being charged the correct rate of VAT, but also in terms of any onward supply that you make. So you want to make sure you're being charged the appropriate amount of input tax and that you're charging the appropriate amount of output tax. What we tend to advise, particularly in relation to high value projects, is that businesses obtain formal advice because it will clearly state your obligations, any limitations, ways you can maximize your VAT recovery position, but if only for the prospect of, if God forbid you do get the VAT rate wrong and HMRC look to assess. If you can show you've done your due diligence and sought professional advice, even if you have got something wrong, then that goes a long way, and we often find that penalties can be mitigated down to zero. So doing your research and due diligence it's important. And we advise doing that as early as possible. Being proactive is much easier from a VAT perspective. Trying to undo something retrospectively can be quite messy, quite difficult, and will end up costing you more money in the long run. So, first slide here talks about exempt supplies in the land and property industry. As you can see from that slide, Examples of exempt supplies are all leases, assignments, surrenders, reverse surrenders, etc., or licenses that occupy any interest in land or buildings. In terms of breaking this down in terms of commercial property and residential property, I don't know what type of property people are involved in, but in terms of commercial property, so that's anything that's not residential in essence, the basic position is that it's exempt from VAT unless it's either the freehold sale of a new commercial property or it's the sale or lease of a property that's been opted to tax. Both of those are standard rated. So in terms of commercial property, you're either looking at, or supply for commercial property, you're either looking at the standard rate or it being exempt from VAT. In terms of residential property, the sale of new residential property can be zero rated, whereas any other sales or residential lets are exempt from VAT. Now, a point that we touched upon earlier is input tax implications. If you're making exempt supplies of land and property, you can't recover any input tax incurred in relation to those supplies. So, for example, residential lettings. If you obviously can't charge VAT on the rent, but that also means that if you incur any input tax in maintaining the property, that will be recoverable. It'll be an additional cost. So it's important to understand these things from the outset so there's no nasty surprises. And just in case there are any steps you can take to mitigate the amount of irrecoverable VAT that you are incurring. So we've talked about exempt supplies. So I'd just like to go through some other examples of zero rated supplies. This applies broadly to the construction and or sale or long lease, 21 years or more, of new build dwellings. We'll come on to what a dwelling is later on, and associated qualifying building materials. Anything to do with a relevant residential property. So that's something like a care home, a children's home, something like that. A new building to be used by a charity for wholly non-business purposes can be zero rated. Wholly being taxable use of 5% or less, or business use of 5% or less. Certain adaptations for disabled people, so adding ramps to a house, increasing doorways, can be liable to the zero rate when supplied to a charity or a disabled person directly, and also the installation of energy-saving materials. Something that is important to think about in terms of land and property in the context of that is that there are often a myriad of conditions that are attached to VAT liability of supplies and construction services and things like that. So it's important to consider those conditions before proceeding with a project. I'll give an example. If you are constructing a dwelling and then you sell that dwelling on, as we've said, that will be zero rated. However, when constructing a dwelling, the works can also be zero rated, but that's subject to the property itself qualifying as a dwelling under HMRC's definition. So a dwelling is often taken to simply mean a place where someone lives that they treat as home. But it's more complicated than that. And it always is with that, really. So if you're constructing a house, a dwelling, not only has it got to consist of self-contained living accommodation, everything you need to live, that's kitchen, bathroom, etc. There can't be any, there's no provision for direct internal access from one dwelling to another. So if two houses are connected and there's internal access between the two, and you're building one of those, that won't qualify for zero rating. Likewise, any new house that you build will need to be capable of separate disposal. We had a case where a lady owned a house, wanted to build another house on the same plot of land, assumed that it would be zero rated, came to us for advice, and we looked at the planning permission, and it said that separate disposal of this new property was prohibited within the planning permission. And so therefore, the works can't be zero rated because it doesn't meet HMRC's definition of a dwelling. One would assume it would, but there's other minutiae involved that you've got to consider before you act in relation to property. It's not always what I would like to think is common sense. And so that's why we advise taking formal advice on these sorts of projects, because the money involved is substantial. If you are constructing a dwelling and it does qualify as a dwelling, the works provided by a contractor can be zero rated. That extends to work to the fabric of a building, work within the immediate site of the building in connection with providing water, power, heat, access, drainage, security, waste disposal. But it also applies to building materials provided by a contractor providing zero rated services. So I'll talk about what building materials are later on, because that is limited in scope. Realize it's a lot of information. Are there any questions at this stage before I move on to the next topic? Okay, great. But I'd like to talk a little bit about holiday lets and service accommodation. This is a bit of a hot topic at the minute because of something called the Tour Operators Margin Scheme, which I'll talk about on a later slide. I don't know if anyone is familiar with that. A supplier of holiday accommodation, service accommodation, will charge VAT at the standard rate of 20% on the full charge, unless the supply falls within TOMS. We'll talk about that later on. For these purposes, that law states that holiday accommodation includes any accommodation held out suitable for holiday or leisure use. It's not got to be a house or a flat. It can be a tent, a houseboat, a caravan, things like that. Clive earlier touched upon the flat rate scheme, whereby you've only got to charge you charge VAT at the full rate, but then only pay a fixed amount over to HMRC, and it's got a built-in element for VAT recovery. This is something that we often see with holiday lets and serviced accommodation. If you're trading below £150,000 in a 12-month period, you can register for the flat rate scheme. And I think the appropriate flat rate for this is 10.5%. I don't know if you know, Clive, if you come across that, but I think that's what it is.
It was on my earlier slide. I can't remember without looking, but I seem to recall it might have been, yes. Yeah,
so as Clive has said, it doesn't allow for VAT recovery, so that's something to consider. However, people using a holiday let most likely to be non-business persons. So VAT that you charge will be recoverable. It's just about how much input VAT you're incurring, whether the flat rate is beneficial to you or not. Justine, yeah, sorry.
Yeah, sorry, it's Angelo.
Angelo.
Yeah, so I see your first paragraph there. You're telling us that it should be the standard rate. So I'm sure I've heard holiday let owners applying for the flat rate scheme and operating with a flat rate scheme. And what you haven't talked too much about, the benefits of the flat rate scheme is all if you go with flat rate, you haven't got all the sort of recording of all the things that are going in and out. Is that right? Is that as a benefit of the flat rate scheme?
It is a benefit, Angelo, but to be honest with you, you've got to record the payments anyway, even if you don't recover the VAT. So it's negligible difference to a bookkeeper and an accountant. So I certainly don't think it's the defining factor. It was touted as such by HMRC when they invented the flat rate scheme, make life easier for people. But people who keep decent records or have to keep reasonable records these days, I don't think it's a major advantage. I think you've got to look at the money and whether you save or lose out by using the flat rate scheme.
Yeah. Okay. Yeah. So although you said that in the first paragraph there about standard rate, you are saying that we can apply for flat rate scheme if we're operating holiday let, yeah?
Yes. Yeah. Okay. So under normal registration, it's standard rated. You can elect to apply for the flat rate scheme and apply a flat rate percentage. But without the flat rate scheme, that's due at 20%.
Yeah, that's fine.
Yeah. So if the rate is 10.5%, the holiday lets, and neither of us can remember without looking at the slide, then it's a decent rate. It often works at sort of 10.5%. Don't forget that the turnover has to be below 150,000 to stay on the flat rate schemes, and some holiday lets can exceed that. So you may not get on it. Jack, you may want to check me on this one because of disaggregation. if two holiday lets are merged together, then it's probably would certainly blow the 150,000, and you wouldn't be able to use the flat rate scheme.
Yes, exactly. Yeah.
Yeah, don't
Yeah.
forget for turnover purposes here, and I've had this argument with people before, it is the gross income that you receive from guests of a holiday let, and is not the net amount that holiday agents like Sykes pay to you, which might be after they've deducted 20 or 25% fees. So you're soon going to hit the registration level, and you're soon going to hit the max out on the flat rate scheme if you take into account the gross income rather than the net income.
Exactly. Yeah. Is that clear?
Yeah, thanks for that. Yeah, I'm definitely recording at the moment over a 12-month period what the gross income is, and I'm keeping a track of that.
Okay,
Good.
So in terms of other standard rated supplies of land, just to mention it, that also includes things like car parking, storage, sports facilities, although there's some quite quirky legislation surrounding sports facilities and where that can be exempt from VAT. So something I'd like to talk about is mixed use development. So we often come across instances where there is a mixed use development. So that is where a property consists of both residential and commercial elements, or converted, refurbished, constructed elements. In cases such as this, it's possible, if not likely, that different VAT rates will apply to different parts of the property. So if you're converting a commercial property to a residential property, we've not talked about it yet, but that's reduced rated. But if you're building 2 flats on top of the existing property, that will likely be 0 rated. So part of the works will be 5%, part of the works will be 0%. So really, we've got to consider how we apportion these in terms of VAT charged on the building works. But there's also a second side to this in terms of input tax.
Mm-hmm.
If you've got an old flat on the ground floor and a new flat on the floor above it, and you sell that, the ground floor will be exempt from VAT. The top floor will be 0 rated, so a taxable supply. So you can recover input tax in relation to the new flat, but not the old flat. So apportionment's needed in that sense as well. So there are quite a few instances where mixed use properties require some form of apportionment or just forethought as to how you treat it, both when you're incurring VAT and also charging it as well. So HMRC allow any method of apportionment that they deem to be fair and reasonable. I've got some examples there. So floor space by square meter, calculate each element subject to a different VAT rate as a percentage of the total floor space, and then apply that. You can do it on a pro rata basis. So the number of new dwellings, which will be 0 rated, compared to the number of existing dwellings, or converted dwellings, which will be reduced rated. Or you can use the relative sales price of the different elements to create an apportionment. Can be quite complex. So before you enact any sort of apportionment method, we advise you get it checked by a consultant or somebody, just to validate your thinking, or perhaps add any input if it's not quite fair and reasonable. So the option to tax, I don't know if this is something that people are familiar with, but it's something that applies in the context of commercial property. So it doesn't apply to residential property. And what an option to tax is, if you've got an exempt commercial property, but you want to treat that as a taxable asset, what you can do is elect that in for VAT. The consequence of that is any supply of property that you make, for example, if you let it out or if you sell it, you'd have to charge VAT at the standard rate. But what it also allows you to do is, because you're making an onward taxable supply, you can recover input tax that would otherwise be irrecoverable. And why people do it? It's to recover input tax on an expensive asset that would otherwise be blocked from recovery. if you're selling a property to a VAT registered business or leasing it to a VAT registered business, they can recover that VAT as input tax. So it's not an additional cost for them, but it does allow you to recover input tax that you would otherwise not be able to.
I'll give you an example here, Jack, of people listening. Hopefully this will help. It's always helped me. With a lot of us have probably rented a room in a serviced office. I certainly have. And that building, all the buildings I've ever rented an office, a room, a single room within a large complex, they've usually charged me rent on that rent. Sorry, VAT on that rent. Correct me if I'm wrong, Jack. Is that because they've opted to tax that building?
Absolutely.
Yeah.
That would otherwise be exempt.
Yeah.
Unless the property owner makes a conscious decision to treat it as a VATable asset. They will have done that to allow them to recover input tax.
It's usually only applied. People have to be very careful when they make that decision to opt to tax, because Jack will go on to say it lasts for about 20 years or something, not reversible.
Yeah.
But it's usually commercial operations like serviced offices. Is it likely to be less relevant to say somebody who owns a business and they have a warehouse or a factory?
Yeah, exactly. So
Yeah.
it's only for people who are making supplies of that property.
Yeah.
If you purchase an office that you are working from yourself, you're not making a supply of that property. Your VAT recovery position is determined by the suppliers of goods or services you make from that property. So it's only when you're selling or leasing a property that the option to tax is relevant. You don't need to opt to tax your own office, essentially.
Yeah.
So there are two stages to opting to tax a property. There is making the decision yourself internally to treat it as a taxable asset. But then the one that people often fall down on is notifying HMRC of that decision in writing within 30 days of making it. So what we often come across is people who have decided they want to charge VAT on letting an office block because they want to recover the VAT, but they've not told HMRC of that. And so they've not completed the two-stage process. So it's not opted according to HMRC. Now, in those instances, you can belatedly notify HMRC. This is something we see a lot. We will write to HMRC on behalf of clients and say, look, the business decided to treat it as taxable. Here are invoices showing they've been charging VAT the whole time and paying it over to you, to HMRC. And they've also been recovering input tax on that. So they've essentially made the decision and just forgotten to tell you about it. Now, usually, provided we've got the evidence, we can, convince HMRC to grant that. But what you can't do is backdate an option. So if you've been treating it, if you rent an office block and you've been treating it as exempt, and then one day you decide, oh, I want to treat this as taxable so I can recover input tax that I've incurred over the last 2 years, that's not something you can do because you haven't charged VAT over the last 2 years. So that there is a distinction there. As I say, the main reason it's done to recover input tax because it creates a link to an onward taxable supply and allows for VAT recovery. If you opt to tax a property from the date the option is effective, you've got to charge VAT at the standard rate on all supplies of that property, be it rental, sale, and you can recover VAT in the maintenance of it. As Clive has mentioned, a word of warning in relation to an option to tax. Once you make it, it's very, very difficult to unmake it. They last for 20 years. There is a cooling off period. I think it's 6 months, whereby if you say it takes me even 6 months, I don't want it opted, they will say, okay, well, we can pretend it never happened. But beyond that, it's very difficult to have an option removed or revoked. It can be done in very, very specific circumstances, but generally it can't be done. So if you want to opt a property, account for VAT on the rent for 5 years, recover the input tax, and then you come to sell the property, the buyer's not VAT registered, doesn't want to pay VAT, there isn't a lot you can do about it, really. You have to charge VAT on that onward sale. So we do get a bit of buyer's remorse, opter's remorse in that sense. So it's something to consider carefully.
Especially these days when perhaps use of office space is less. Let's say that owner of that building who used to rent a room to me wants to sell that building, which is worth several, maybe millions of pounds. and the only use of it is to convert it to residential, then if one of us was a residential landlord and said, yeah, we'd like that property, convert it into HMOs or bedsits or flats or something, instead of it costing £1 million, we'd have to pay 1.2 million because it charges VAT. So we may look elsewhere for another building.
Well, you've actually touched on something there, Clive. As I said, there are a number of situations in which the option can be revoked, and one of them actually is where the intention is to convert it to residential property.
Okay, thank you.
So it can be revoked in circumstances such as that. I think it also, if you're granting it to a charity for non-business use or selling it to a housing association, but the main case where we get opters remorse is that someone wants to buy it and operate it as an office, but they aren't VAT registered, they don't want to opt it. They either have to pay the VAT and treat it as an irrecoverable cost, or then they've got to register and opt it, and it's more administration for them. They might not want to do that. That's when it can become a bit of an issue.
Okay, great. Thanks for the clarification.
We have touched on this, but we've talked about exempt supplies, standard rated supplies, zero rated supplies, and we've mentioned reduced rated supplies. That is supplies subject to VAT at a rate of 5%. But to go into a bit more detail, broadly, it applies to conversions, conversion services. So that might be where you are converting a commercial property into flats. Your contractor can charge you 5% because what you're doing is you're changing the number of dwellings within a building. So you're changing it from 0 to however many. But it also applies if you've got a property consisting of 3 flats and you want to turn that into one big property. That's changing the number of dwellings. So qualifying services in that regard can also be subject to the reduced rate of VAT. Now, qualifying services is as it was with zero rated construction. So work to the fabric of the building, anything done to provide fuel, power, water, etc. Things like that. The reduced rate of 5% also applies if you're converting like a care home into flats, changing the number of dwellings. Another instance is in relation to the 2-year rule. If you've got a residential property that needs refurbishing and it's been empty for 2 years, usually those works would be standard rated. But if you can demonstrate the property's been empty by obtaining council tax records or utilities bills, then the contractor can charge VAT at 5% instead of 20%. So that's the instances in which it can apply. But a concept that we mentioned earlier, which I'll touch upon now, is the concept of building materials. So this also applies to construction. Building materials can be zero rated when provided by a contractor providing zero rated services, and likewise with conversions. If a contractor is providing services that are subject to 5% VAT, and he also provides building materials, they can charge to 5% VAT. So building materials consists of goods that are ordinarily incorporated into a building and require the use of tools and result in the need for work done to the fabric of the building. So wooden floors, things like that. Goods that are not incorporated into a building can't qualify for the 5%. So that's appliances that are merely plugged in, freestanding furniture, white goods, carpets. They'll be liable to the standard rate. And if your contractor is providing both zero rated, both reduced rated and standard rated goods, they'll have to show them separately on any invoice. So that's something to consider. And as I say, that applies to construction as well. If you're buying building materials alongside construction services, they can be zero rated. If you buy these in isolation, if you go to B&Q and buy what would otherwise be classified as building materials, they will still be standard rated, but they've got to be provided alongside qualifying conversion services. So in relation to construction and conversion services, only qualifying services can be reduced for conversion or zero rated for construction. Specifically excluded from the zero rating, reduced rating are the supply of architectural, surveying, consultancy or supervisory services. If you hire goods in isolation, such as scaffolding, That will always be standard rated. But that can be recovered as input tax, dependent on the VAT treatment of your own supply. If it's a new build flat, zero rated, when sold on, provided it meets the conditions for a zero rated sale, so you can recover that as input tax. If you're letting the property, it's exempt, so that will be an irrecoverable cost. So I'd like to talk a little bit about the DIY house builder scheme. I don't know if this is something that people have come across, but it was brought in to put DIY builders or converters into broadly the same VAT position as a developer. It doesn't only apply to people who undertake the construction or conversion works themselves. If you're commissioning someone else to do it, then that is sufficient for you to seek a reclaim through the DIY house builder scheme. And under the scheme, you can reclaim input tax incurred on the construction of a property or conversion of a new residential property. This applies to goods that would be zero rated or reduced rated when supplied alongside qualifying zero reduced rated services. But VAT can't be recovered on goods or services which would be liable to the standard rate. So that's the professional fees we just talked about, and the hire of goods in isolation. So to utilise the scheme and to claim back VAT on building materials, the following criteria must be satisfied. The goods must be used in connection with work which comprises the construction of a building designed as a dwelling. This is where the definition of a dwelling, as we talked about before, comes in. The use of the building must be for a relevant residential purpose, i.e., it must be for that person to live in or a member of their family to live in as their main residence. And in terms of making the claim, this is where people tend to fall down. So only a single claim for input tax can be made, and that's got to be made within 3 months of the completion of the dwelling. So what we often find is people will get the certificate of completion. It's 4 months later, they go, I want to submit a claim. They can't, because that 3-month time frame has passed, and that starts when the certificate of completion is dated. When you submit a claim using the appropriate form, it's something like a VAT 1431D or something like that, but it should be easy to find. You need to provide a schedule of all invoices that you're claiming for and copies of those invoices, but just make sure you retain copies as well, because HMRC are the best at keeping documentation. So, Tom's, the targeted margin scheme. I'll be honest here. I think it's a widely held view by myself and my colleagues that Tom's is a little bit of a pain because it's so complicated. Despite the name tour operator margin scheme, it doesn't just apply to supplies by traditional tour operators. It also applies to the supply of designated travel services, i.e. accommodation, that are bought in and then resold to a traveller without material alteration or further processing.
Can I just give an example there? I met a lady within our group of people who facilitates people from abroad who want serviced accommodation. So we are talking about something that could be quite relevant to people who provide serviced accommodation or holiday lets, probably as well. So I just wanted to say that because although it's very complicated, and Jack will talk about whether it helps or doesn't help and how it works, it's on the surface of it, it could be reasonably relevant topic.
Yeah, I think it's increasingly relevant due to a recent ruling which we'll talk about in relation to serviced accommodation. But if it makes supplies that fall under the scope of TOMS, you have to apply TOMS. And what it means is that a business will only account for that on the profit margin for a stay in a property that it purchases, as opposed to accounting for that the full sales price. So there is a benefit there because it creates a VAT saving for the operator. Input tax is not claimable on supplies bought in to make a Tom supply. That's why only accounting for VAT on the margin is beneficial. So where a business is only required to keep the property clean and the landlord is responsible for any maintenance, Toms can be used. But if you're responsible and making material alteration to the property, then it wouldn't apply. It's come into the spotlight a little bit, Toms, recently, due to a case heard by the VAT tribunal. I think it was July time last year, and the appellant was a business called Sonder. And within this case, the application of Toms was discussed in the context of serviced accommodation, leased by a provider from landlords who would then sell it on to the public. So HMRC's argument was that this didn't fall within Toms, as the business was acting more as a hotelier, essentially leasing a property in a long period and then granting several shorter leases to the public for short stays, essentially. And they also argued that if they furnished the property, as a lot did, it would constitute material alteration, and therefore Toms wouldn't apply. However, the tribunal disagreed with HMRC, sided with the taxpayer, and took the view that if it was simply buying in and reselling accommodation, Toms does apply and has to apply on a mandatory basis, which would change the way people account for VAT on supplies of this nature. So HMRC are definitely going to appeal. I think the appeal is in the pipeline now. And the reason for that is because if the higher court agrees, or this ruling is not challenged, then it opens HMRC up for people providing serviced accommodation to make a claim for VAT where they've accounted for VAT on the full price, whereas they should have only accounted for VAT on the margin made. So it's something that they're quite seriously fighting. I think the case should be heard hopefully soon, but these things can take quite a long time. But if you're providing serviced accommodation, it's definitely something to keep an eye on, for sure. It's quite a hot topic in VAT at the moment. So if this applies to you, and if you want a bit more information about what the case is, what it means, how it would affect you directly, I'd suggest following up with me another time, because as I say, trying to distill it simply is challenging. But I think if it's relevant to you, it's something that's definitely worth considering and exploring in a bit more detail. If you are a builder and developer, it's crucial to consider VAT in two ways. So firstly, the VAT that's due on supplies that you make to ensure that you're accounting for VAT correctly. So if you undercharge VAT, so if you account for VAT at a zero rate when it's a standard rated supply, you are open to being assessed by HMRC, with HMRC raising penalties and potentially charging interest and things like that. Equally, if you overcharge VAT, so if it's a zero rated supply you're making and you charge VAT at the standard rate, this is an irrecoverable cost to the customer, even if they are VAT registered, because you cannot charge VAT, you cannot recover VAT that has been incorrectly charged. Now, something HMRC expect, which I find a little bit unfair, is they expect everyone who buys anything to know what the appropriate rate of VAT is on that purchase. Because what they say is, if you buy a book for your business, that should be zero rated. But if you're charged VAT at the standard rate, and you recover that as input tax, you as the customer are exposed then, because as far as HMRC consider it, you've made a mistake in recovering VAT that you're not allowed to, and that might open you up for potential consequences. So if you're a supplier and you've overcharged VAT, you're potentially exposing your customers then, which isn't a particularly good look, really. Likewise, if you're buying, if we then consider input tax as the flip side to output VAT, it's important to get output VAT right, partially because that also has an effect on your ability to recover input tax, the VAT on your purchases. So that's namely if you make exempt supplies, the various exempt supplies that we've talked about, which can constitute a fair amount of land transactions. that would mean that you're not allowed to recover that input tax. Likewise, if you convert the property and the contractor charge you 20%, but it should be charged at 5%, you can recover 5%, but that 50% needs to be got back from the contractor. So you need to know what the appropriate VAT rate is from an output and an inputs perspective. So from an inputs perspective, there are a number of things to consider to maximize your VAT recovery position. So something that some people do is they'll construct a zero-rated property. They'll construct a new dwelling, works as zero-rated, but then they want to rent it. That's exempt. Any VAT that they've incurred on architect's fees, etc., or any VAT that they will incur on the maintenance of that property will be irrecoverable because it relates to an exempt let. So you can then consider alternative structures. What some people do, and we've advised similar structures in the past, is that if they make a qualifying zero-rated sale to a connected company, that allows the business to recover all the VAT because it's linked to an onward taxable supply. They're not charging a positive rate of VAT to this connected company. It's zero-rated, and this connected company lets out the property. They have not incurred the input tax to date, so they're not losing out from an inputs perspective, and it allows the business that would otherwise be blocked from recovery to recover the VAT that they've incurred. So there are certain structures that you can implement that we can advise on potentially, and so it's always worth investigating whether there is anything that you can do to maximize the amount of VAT that you're able to recoup. So in this context, there's a couple of things to consider. So there are specific anti-avoidance provisions in place, and they apply to any scheme set up to recover VAT incurred on a property which is ultimately used for an exempt or non-business use. So if a taxpayer grants a right in a property to a purchaser who's connected, then the anti-avoidance provisions will pick that up. It's similar to the structure that I just described. So if you're going to implement that, you'll need to obtain advice to make sure you're not caught by the anti-avoidance provisions. Likewise, in terms of input tax, there's a consideration called the capital goods scheme. So that relates to capital expenditure, including land and property, that is of a value greater than £250,000. What the capital goods scheme does is it requires the purchaser who recovers the input VAT on the purchase. If there's no VAT on the purchase, then you don't need to apply the capital goods scheme. It requires them to monitor the use of the land or the property over the next 10 years. And where there is any exempt supplies made or non-business supplies made, what they would need to do is pay back some of the VAT that they'd already recovered. So for land and property, you have to monitor it for 10 years. So each year, 10% of the VAT that you have reclaimed is up for clawback. If in the first year you make 90% tax supplies and 10% exempt supplies, because you've recovered all of that, you need to pay some of that back. And that would amount to 10% of that year's portion up for grabs, or 1% overall. I think the first capital goods scheme interval starts when you first use the asset, and it concludes the day before the start of the next tax year, and then subsequent intervals adjust the tax year. So it's not too complicated when you know what you're doing, but just getting set up on knowing what you're required to do, knowing how to use the asset is something that you should consider. Likewise, partial exemption. So I'm sure this is something that some of you are aware of. It's probably the theme of the webinar. You can't recover VAT in relation to exempt supplies. If you make both taxable and exempt supplies, you are partially exempt for VAT purposes. It's a clever name, I know. What happens is you need to apportion input tax to determine the extent it relates to a taxable supply and is therefore recoverable. So that involves a process called direct attribution, which is classifying input VAT into 3 categories: relating solely to taxable supplies, that's fully recoverable; relating solely to exempt supplies, that's fully blocked from recovery; and relating to both taxable and exempt supplies, that's known as residual input VAT. And you've got to perform a calculation to residual input VAT to determine how much is recoverable. I think the standard method is you work out taxable income as a percentage, say it's 50%, you can recover 50% of your residual input VAT.
Would it be right to use an example, Jack? just check that this example is correct. If I have a limited company and I've got 2 properties in it, one is a family buy-to-let, obviously exempt, and I don't charge VAT to the tenants. But the other one is a cracking great big holiday let, and I'm well over the threshold, and I charge VAT on that. In terms of reclaiming my input VAT, if I incur a charge like the agent Sykes or Holiday Cottages, and they charge me VAT on their management fee that relates to the holiday let, I can claim all of that VAT back.
Yes.
If I have a repair on my family buy-to-let and the builder charges me VAT, I don't claim a single penny of that VAT because that's on the family buy-to-let. Is that right?
Correct. Yeah, correct.
But if I have something like a general expense, like my accountancy fee,
business overheads,
business overheads, then I will, and I'm charged £1,000, £200 VAT, and let's say the holiday let is twice as big as the family let, so that's a third. Well, I can't divide 200 by 3, but more or less £70. So I'd reclaim about £140 of that bill, 2/3, and not claim about a third of the proportion of the family buy-to-let.
Exactly right.
Yep. Okay. Good. Because that's a good example, hopefully, for people on here.
So some, in addition to partial exemption, I won't talk about this too much. Some businesses, complex organisations, make non-business supplies. You can't cover VAT in relation to those either. If you make non-business supplies and exempt supplies, such as a charity, you need to perform 2 apportionments. It can get complicated. Seek advice. So my last slide is regarding the domestic reverse charge. So this is a requisite to be used for most supplies of building and construction services provided on or after 1st of March 2021. That's when it's implemented. So when invoicing a contractor for qualifying goods and services, the VAT registered contractor will not add VAT to their invoice. Instead, what will happen is the contractor will self-account for output VAT on their VAT return and recover that as input tax, much in the same way as we talked about for reverse charge services purchased from abroad. It's much the same process. It's a cash flow benefit for contractors because they've not got to pay that and then wait for the next VAT return to recover it. Instead, they pay it on the VAT return, recover it on the same VAT return, 2 equal and opposite charges. So I think it was brought in to prevent fraud in the construction industry. There were subcontractors charging VAT when they shouldn't. So contractors were then paying it, couldn't recover it back. And it was causing a bit of an issue. To use the construction industry scheme CIS reverse charge, contractors must register. And if they issue an invoice for supplies subject to the reverse charge, they need to include a reference to the scheme on it, stating the value of output VAT due or the rate of VAT applicable. Although that VAT wouldn't be paid to the subcontractor, instead the contractor would account for it on the VAT return. So there are several instances where the construction industry scheme reverse charge doesn't apply. That's if the services involved are exempt to 0 rated, because there's no VAT to account for. It doesn't apply to services that don't qualify as building or construction services. So like professional services, such as that of an architect or a surveyor. Hire of goods like scaffolding with no labour doesn't apply. Things like installation of security systems. There's a specific list of what does and doesn't qualify. If it's relevant to you, you need to look it up. It doesn't apply to businesses that are registered and aren't registered on the CIS scheme. And it doesn't apply when the services are provided to customers who are either end users or intermediary supplier businesses. End users is the owner of the property or the business that uses the construction service to make a different type of supply, so they don't sell the construction services you provided onwards. So we're making supplies to end users. The reverse charge won't apply, you just charge that in the normal way. Likewise, intermediary suppliers are businesses connected to an end user. So if they disclose that they have a relevant interest in the land or are part of the same group as the business that owns or leases the land, you wouldn't account for that on the reverse charge either. You would just charge that at the requisite rate. So really, it's a big issue for subcontractors, for contractors. But if you're receiving these supplies from contractors for your own use, you own the property, then that will probably just be charged in the normal way, so it won't affect you. But just look out for a reference on the invoice to this scheme. And I think that's everything that I wanted to cover.
Okay, thanks, Jack. That's great. We have used most of our time up, but as Jack said throughout, some of these issues are quite complicated and can't easily be answered on a webinar. And as I always say with all of these webinars, because none of us are experts, even the experts, it's hard to take it all in, certainly hard to remember it, but it just serves to make you aware that these issues exist, and to get things right, sometimes you have to be prepared to do the research and take the advice, because the advice could save you a lot of money, either in avoiding being taxed with a penalty, but better still, by actually creating a saving for you at the outset by reducing your tax or claiming more than you even thought you could do. We will open it for questions just for a few minutes. Just on that last point, we were discussing it before the webinar started. How might somebody in this webinar who's doing property, is it possible for them to become a builder or developer if they, or will they, or would that only happen if they self-built? And if I was a builder and was working on my own property, converting it, and I employed the services of subcontractors, would I become a developer or builder in that moment?
Not for the purposes of the reverse charge, because you are an end user in that respect if you own the building. But if you were working on someone else's property and you purchased the services of a subcontractor, that's when you would account for that under the reverse charge on the services of a subcontractor, because you're selling those on to the end user. If you're consuming those services yourself, because you own the property, or you're connected to someone that owns the property and you disclose that, then the reverse charge wouldn't apply.
Okay. All right, let's open it for questions. Put your hand up, please. Bob, unmute and ask away.
Hi, thanks for all that, Jack and Clive. It sort of almost got buried in the subtext, but there was a reference to TOG C, a transfer of an ongoing, transfer of a going concern.
Yeah,
and I wasn't clear at all about that section and how it works. Could you run over that again, please, Jack?
Yeah, so a TOGC, I think due to time constraints, I didn't cover that in too much detail, but a TOGC, or a transfer of a going concern, is where in essence you sell an operable business. So in the context of land or property, if you were selling commercial offices with a tenant in situ, you're not selling land, you're selling an operable business. So a tenant needs to be in situ for that to apply. Now, a TOGC that meets all the conditions is actually VAT free, so you don't charge VAT on that. So it is something that people look to utilize a lot, because if you're transferring a whole business, the VAT's substantial. So what they try and do is ensure that these TOGC conditions are met in the context of property. If you owned the commercial offices, you could sell that to a tenant in situ, not charge VAT. But in order to do that, the purchaser would have to be VAT registered where you're VAT registered. They would have to opt the property where you've opted the property, because the intention is that they carry on the same type of business that you did before the transfer.
Okay, I'm thinking more in terms of a scenario like a holiday let, an SA, or even or an HMO, which is held inside a limited company and being sold to a new purchaser as an operational, let me call it an operational property. So it's on the one hand an existing business. It's a building which is already converted for whichever purpose, be it HL or HMO or whatever. And another party comes along and says, right, I'd like to buy that off you. What's the differentiation between buying a building versus buying the business element of that property?
So
where does VAT then figure in either scenario, or doesn't it, or do you get caught both ways?
So where you're selling a residential property, yeah, so part of that would be exempt anyway, as it's residential. I suppose with a tenant in situ, you could consider that VAT free, but it would already be, I think, VAT free. And I must be honest, I've not come across it in terms of a holiday let because, and I think the reason why that might be is because with, say, an office space, to be a continuation of a business, it's got to be a tenant in situ. So at
There
least
isn't a
already
tenant in situ in a holiday let because they're just
Exactly.
they're temporary people. And with your HMO, where there may be tenants in situ, an HMO by definition is purely residential, can't be, and the supply is exempt, i.e. the rent is exempt, like it is in a buy-to-let. So for me, TOGC really only happens in non-residential businesses, such as I could sell my accountancy practice to a younger accountant who wants to buy it. And if I'm VAT registered, and he is, we simply agree between each other to apply TOGC and both sign the form. And it's really done just to avoid the cash flow problem between me as paying the output tax and him reclaiming it, but it also avoids fraud because he could pay me for it and I could do and reclaim it, and I could do a runner and not pay it. Would you agree with what I said, Jack?
Yeah, I'm just looking at the holiday let point because, as I say, it's not something I've come across before. But just looking at that specific point, if it's in use as a holiday let and there are, say, bookings in place,
Yes.
And then the new owner continues to operate it as a holiday let,
Yes.
and I think that would be possible to operate as a TOGC. But what I would advise is looking at that in a bit more detail. As I say, I've not seen it in the context of a holiday let before. I see it quite a lot, but it's whether this is just dumb luck. It seems to always be in the context of offices or something like that.
Well,
but it does look like it's possible.
Yeah, I mean, if you've got an SA and the scenario where you've got contractors in that SA from one of the local employers on a long-term basis, say there's a 6 month contract in place with the local I don't know, Santander headquarters. It doesn't matter what the company is, and their contractors are in that property under a 6 month contract, and 3 months in, the owner sells that property, but there's still a contract in place for a further 3 months. And let's assume for the sake of illustration, that the deal and the completion and everything goes through on the 3 month point. Would that be classed as a going concern? Would that be classed as buying that property?
Yeah, it could potentially be classed as a going concern. Yeah, I think what I would say is there's quite a lot of conditions that are attached to that.
How do you evaluate it?
So you'd need to look at how the business would operate before and after. As I say, if the previous existing seller is VAT registered and things like that, the new person would need to be VAT registered at the date of the transfer. But in theory, yes, I could see that potentially being a TOGC.
There is one issue there, Bob, and that is that you've exceeded the 30 consecutive days to the same person, and therefore you fall outside the HL/SA regulations, which are going to be withdrawn next year anyway. A 6 month contract becomes a I've forgotten what is AST it's called, and an AST automatically prevents it being SA. Becomes a buy to let for 6 months.
Right, that's interesting. An interesting nuance.
Yeah. I think it's in the time we've got. We're here to try and answer questions 100%, but with this one, I think some thought has to be given to it because there are multiple issues here with the tenancy, the 30-day rule, the AST rules, and whether a holiday let, albeit not taxed as residential like a buy-to-let or HMO, the point is that it's capable of being residential, as is SA. And therefore, that's another little nugget that needs to be explored.
Okay, well, I'll perhaps take the detail of that up with you offline, Clive. But
yeah, absolutely. I think it's a great question.
The rhetorical question, or to conclude that, is if you miss TOGC or AST scenarios in that example, what are the consequences?
Well,
on the transfer.
Yeah.
Nature of the business.
Yeah, absolutely. Correct me if I'm wrong, Jack. Isn't TOGC completely voluntary between the buyer and seller?
Yeah.
And they both have to sign the same form, the same piece of paper, not two separate identical forms, but the same one has to be signed by the buyer and seller. So if they miss it, it may be because they don't want to, and the only reason why they don't want to is because either they can't, or perhaps they're not bothered about the cash flow inconvenience. Because really all it is designed to save the cash flow inconvenience.
Okay, I don't understand that, but I don't want to hog the entire Q&A session.
Okay, we'll speak later, or you can speak to
Unless
Jack.
anybody else wants to continue it on.
Yeah, well, we haven't got long, and I think we should. Clive Brown's got his hand up. We're happy to go a couple of minutes over, but not too long. We're all a bit tired. Okay,
thank
Clive.
you both.
Clive Brown.
Yeah, it's a quick thing. You're talking about the 5% VAT if a property is you're increasing the number of properties or decreasing, or the property's been empty for 2 years. The VAT on that, do you actually reclaim the VAT from HMRC, or like if I was to buy building goods, the building supplier would not supply me the goods at 5%. So do I then reclaim it from?
Yeah. So if you're buying building materials separately, so not through a contractor providing reduced rate conversion services, they will likely be charged at 20%.
Yeah.
You can recover the VAT that you incur as input tax, dependent on the VAT liability of your onward supply. If your supply, so if you're going to let out those residential properties, you can't recover that VAT because you're only making an exempt supply.
Or even if it's at the 5%, it's not an exempt.
So the conversion works at 5%.
Yeah.
What dictates your VAT recovery position is the supply that you make. That's either selling it or letting it.
Right.
So if you're refurbishing, correct me if I'm wrong, Jack, I always say that, if you're converting a buy-to-let, which is an exempt supply, when I charge rent to my buy-to-let family tenants, they can't ever pay me VAT because rent in that circumstance is an exempt supply. I can never, whatever VAT I've been charged by B&Q as a supplier, or by Bob the Builder as a construction person who's supplying labour and materials, I can never recover that. Is that answered your question, Clive? And is that
so
correct, Jack?
even if I sell it on, you still can't claim it back at 5%.
So if it's the first sale in a new property, then that's zero rated. But you've got to be careful of that where you're selling a property that previously consisted of another residential property. It might not be considered a new residential property then. That's something you've got to be careful about, the specific guidance around that.
Yeah, a few clients of mine have just happened in the last few years. I've had quite a few clients doing this, where they've bought a commercial building, a shop, a retail shop, and they've converted it into a residential house. It's the first conversion of that phrase that Jack used, the first conversion in the last out of commercial. Then that onward supply is zero rated, I believe, Jack. But because it's not exempt and it's zero rated, so I don't charge that when I sell it. But because it's zero, I can reclaim all the VAT that I'm charged, and potentially will only be charged 5%. Is that about right, Jack?
So if you actually resell it, so if you rent it, you can't do that.
No, because that's an exempt supply, not a zero rated supply.
Right.
Okay. Just one last word, but we've also got to be careful of. If you're converting from commercial to residential, there's no question that the first sale you make is in a new residential property.
Thank you.
Yeah.
But if you've got say 2 flats, you convert that into 3 flats, that first sale, it was residential before, it's residential after. So I'm not quite sure that would be a qualifying zero rated sale.
Because what I was looking at is I was actually looking at something that's got they've got 1 property at the moment, and they've got planning permission to convert it into 2. So we can actually do like big extensions on the side and everything else. So I will end up with 2 properties.
I'm not sure that the sale of those properties would be a zero.
I'm not sure either, but it's worth checking. But I'm not sure at all.
Because it was residential before,
Correct.
and it'll be residential after.
So I might not be able to claim VAT back.
But potentially, no. If you want to follow up
Potentially
with me
not,
on
no.
that, I'm happy to, but my instinct might be an issue there.
Right.
We've
Okay.
got a couple of questions in the chat. If you finish there, Clive, is that okay?
Yeah. Thanks so much. Thanks.
Thank you. We've got Kate with a hand up, and then we'll just have a look at what's in two quick points in the chat. If James and Rihanna are still online.
Okay. I can't see anything in the chat. Sorry about that. Kate, what was your question?
So it's about the revoking of VAT on an elected commercial property.
Mhm.
So in an auction, you see a property, it's X £1,000 plus VAT. If you have this intention to convert to resi that you mentioned allowed you to revoke that VAT, at what point can you revoke it? Between bidding at the auction and actually paying the money, or do you claim back later, or is it definitely grantable, or is it up for debate?
So you're buying a property at auction and
A
then
commercial property, I presume, Kate.
Yes, so a commercial property with dead uppers right for conversion to resi, but never has been.
Right. So you're buying it, electing to opt to tax it, and then later on down the line, you're going to revoke that option to tax.
No, it's
I think that it's already had an option to tax by
Yes.
Fred Bloggs, the previous owner. He's put it in the auction, and it's £100,000 plus VAT. Kate wants to buy it with the intention of converting this commercial property into residential, but she'd like to recover that £20,000 VAT.
Exactly.
To recover that VAT, you've got to establish a link to an onward taxable supply. And if you're going to be converting commercial, so the option to tax would cease to apply on the sale to you. His option won't carry over to you. You would have to decide to opt it yourself.
I don't want to opt in. The whole point is I want to get rid of it. So on the sale, I could go, actually, I'm not going to pay that VAT that you asked for because
no, you've got to pay that VAT.
Yeah.
He can revoke the option. And let me just check when he would.
Don't forget, Kate, this is what Jack called opter's remorse. This chap who opted to tax it all those years ago as a serviced office block was very happy. When he comes to put it in auction and he's faced with somebody like yourself, he'll be very sorry. So Jack's having a look at this now to see if this chap can revoke it before the hammer falls on the sale.
So do you think it's him, the vendor, that revokes rather than me, the person?
Yes.
Yeah, I don't think you've got any control over the situation.
Oh, I see. So he'd go, standardly, he has to stick to it for the 20 years. But if he knows he's selling it to someone who's going to convert it to resi, he can get it revoked?
Yes, he'd need to submit a certain form. He can do that before the sale. But that's something that he'd need to take care of. He can do it before the sale to you, but he would likely need some form of guarantee that you will be converting it to residential use.
But in an auction, the vendor doesn't know who is buying it. So I might go, oh, if I get it, I'm going to convert it to resi. But how does that vendor know who the purchaser is going to be?
Well, in the event he doesn't know the purchaser, I'm not sure that's possible then. Because he can't revoke it on the basis it's going to be turned into residential property if he doesn't know it's going to be turned into residential property.
He may have to choose to do a private sale, Kate, rather than an auction, where he can get an undertaking from the buyer, you, and where he might be able to, is it monitor it for the next 10 years? Or was that something else?
That's capital goods scheme, yeah.
Sorry, that was that.
But he might need, I can't remember the form, he might need the buyer to sign the form to confirm that they are going to convert it to residential.
And then only submit that form if that buyer actually gets it?
Maybe.
Well, I think buying it in an auction makes it very, very complicated. I think it needs to be a private. I mean, I suppose it's workable. But I think he would have to submit that to HMRC before the sale. So in fact, I'm not sure it is workable.
Do you think it has to go in before?
And I think it needs to be a private sale.
Hypothetically, could a vendor kind of make the sale in that auction conditional upon whoever buys it, if they want it 20% cheaper, have to commit to converting to resi?
Yeah.
All these things are possible, Kate, but I think it needs looking into.
Yeah.
I mean, it's strange that a property would come up like this because the seller would surely not what should want to take advice himself before putting it into an auction, because
Well, it's interesting because I've seen two properties that I've liked that seem really cheap, got VAT on them. That's why I think they've been cheap. They failed at the first auction, and I think then both of them sold for quite a bit less second time around. So eventually someone goes, "Oh, sod it, I'll pay the VAT anyway." Now it's that cheap.
Yes, but
it's obviously been a struggle for them.
Exactly. They've had
If
to
you're
swallow it.
if you're converting the property to residential, if you sell that property and it qualifies as a zero-rated sale, you can recover that VAT anyway.
Say that again.
If you're converting a commercial property to residential,
Right.
on completion of that, if you sell the new residential property and it's the first grant for major interest, that would be zero rated. And if you're VAT registered, that would establish a link to an onward taxable supply, so you could recover the VAT incurred on purchase.
Oh, okay.
Yeah, that's exactly what the advice I gave to Clive Brown a few minutes ago.
Yeah,
if you want to keep that property as a resident and rent it to a family, then that's an exempt supply. You can't reclaim it.
But if you rented it commercially,
well, let's just go through the other one. If you sell it, then it's zero rated, so you can reclaim the VAT that you've paid.
Okay.
Yeah, you just asked if you don't sell it, but you rent it, keep it as commercial, then that doesn't work anyway, because we're talking about, oh, does it work, Jack, or does it not work because you've not converted it to residential?
So if it's staying commercial, to recover the VAT, you'd have to opt to tax it yourself.
Yes, you'd have to opt to tax it and just carry on like the vendor did. Yeah.
So the best way is pay the VAT anyway, convert it to resi that you're planning to do anyway. Don't get any forms filled in.
Well, get it as cheap as possible. Get it as cheap as possible, or try and contact the vendor and say, "Hey, why don't we work something out between us? Use the solicitors, and I'll give you an undertaking." Maybe that works. We don't know, but it's possible.
Okay, great.
I'm just going to be very, very quick because it's late. I'm just going to. James and Rianne were confused about the 3-year reclaim of VAT. If I register for VAT today and I bought a van a year ago and paid VAT on that van, then because I've still got that van today, I can reclaim the VAT. And I could have bought it any time up to 3 years ago. If I've registered for VAT today and 3 months ago, within 6 months, paid a solicitor a fee of £1,000 plus VAT, I could reclaim that VAT because it was a service that I had within the last 6 months before registering for VAT. I can't reclaim VAT on things like petrol that I incurred a month ago or 3 months ago or 6 months ago, because I no longer have that petrol. I've already burnt it up.
Consumed it, yeah. It's got for goods. You still have to have those goods on hand.
Yeah, or the benefit of the legal advice in that example.
For a service, yeah.
Yeah. I think that was really the only thing that was asked. James and Rianne did ask, what should we pay for HL? But I'm not sure what that question means, but hopefully we've covered it anyway. I do think we need to tie up, really. We've got over time. So I won't dwell. I'll just say thank you very much to Jack. Jack's available directly. You don't have to go through me. You can go through me. It's not a problem. I don't get anything for it. If you lose his nubs or you want to run it by me to see if he's the right person, or if I can answer it anyway. But anything complicated, frankly, I always use a VAT consultant. So without any further ado, thank you for attending. Thanks for your questions. Thank you, Jack. Hope you've managed to stay awake. It's a very difficult subject, but at this time of night. But we'll wind up there. Thank you.
Thank you all.
Thanks everybody.
Thanks, Clive. Thanks everyone.
Cheers, mate. Cheers.
Bye.
Bye.